Let me ask you about crude oil. Since we're talking about commodities, I know it's where this happens to be one of the big drivers, of course, that you had once, at some point, you were looking at $200 a barrel. Is that still possible?
I don't think so. That was really in all the scare of the war coming and everything else. And we got WTI up to 125 a barrel. And as long as the thing is, it doesn't need to go to 150 or 200 to continue to provide tailwinds for inflation. I mean, oil staying where it is today could lead to a 7% CPI for the year 2020 as a whole. We look at the forward curve on West Texas Intermediate crude oil, and it actually suggests that we would have a lower oil price than where we are today later on this year. But if we just stay where we are, about $100, $105 a barrel, we could very well have a 7% CPI for this year. And this is what, going back to how we started the conversation, Charles, that's why there's this Mr. Magoo problem. The Fed is talking about bringing inflation down, and yet there's little reason to believe it's going to go anywhere close to even a 4% level for the year 2022. So they're kind of stuck. You know, they waited too long to raise interest rates. The bond market was way ahead of them. The two-year Treasury is always the leader for what Fed policy is going to be. The two-year Treasury was at 15 basis points about a year ago, and then it went up to almost 275 or so, basically taunting the Fed and begging the Fed to stop with the zero interest rate policy. And the Fed had to do it once the spread between Fed funds and the two-year got so ridiculously wide. And so there's good news that the two-year has relaxed in the past several trading days or couple of weeks, but it still suggests that the Fed has got to raise rates a couple of 50s.
Sure.
And with the bond market trading getting much more illiquid and much more cautious, and the stock market going down in an orderly manner as well, I think we're going to see some disorder and putting in another leg down on risk assets that will be scarier than the one that we experienced in the past couple of weeks, because
so, Jeffrey,
it will be more disorder.
Let me ask you then, because it seems to me, and then yesterday was another example, you're talking about this taunting, where the Fed keeps going out of its way to tell us, no, we're not going to go 75. They had a golden opportunity yesterday after the CPI number and the reaction in the markets, and still you had a couple of Fed heads say, no, we'll stick to 50. What's their reluctance? Everyone expects them to do this. People want them to do this. The market probably would cheer the move. What do you think's holding them back?
It's the Mr. Magoo problem. It's such a blunt instrument that they've got no idea at what level things are going to start falling apart. So they want to do it slowly, but they're so far behind. I understand your point, Charles. They're so far behind that the people, I remember there was some commentator that was saying they should just do, 75 right now, like not even wait for a meeting, just do it. And the market probably, the market probably wouldn't find that to be such a problem, because the bond market is already saying you've got to do this. Mm-hmm. So, yeah, they're just very slow, and they want to make sure that they don't just go diving off a cliff or off of a diving board into a swimming pool that has no water. So they're kind of feeling their way along, but they're going to have to do these 50s. And I am surprised that they are so clear in their communication of no 75.
So you're in Buffalo for the Albright Knox Gundlach Art Museum, which, by the way, I looked at the renderings. Absolutely amazing. So tell us about this project, because it certainly looks like a labor of love.
Yeah, the museum was built, the original building was in 1905, and it was completely falling apart. They call it deferred maintenance. I call it neglect. And then there was another building that was built in 1962, and that also has to be upgraded for ADA compliance, everything else. But the most important thing is, the museum is one of the greatest modern art museums in the world, and yet it is very small in terms of its physical plant and can't show the hundreds of renowned masterpieces that are acknowledged by art enthusiasts around the world. So we decided we needed to upgrade the old buildings and build a lot more space. So we're building a new building that's doubling the size, actually a little more than doubling the size of the Prime Gallery space. And we started raising the money 6 years ago, and I'm happy to say that the fundraising just in the last month or so has become complete.
Oh.
And the museum, the new building and the refurbished campus, it's amazing. We're doubling the size of the gallery space, Charles, and yet we're increasing the amount of green space because we're putting the parking lot underground. So we're actually increasing the green space while increasing the gallery space. We're looking forward to opening, if all goes well, and I think we're on track, in the spring of next year. And so it would be great if the weather on that opening day were like it is today in Buffalo, because it's like a paradise here today.
Well, I got to tell you, I'll definitely make the trek up there. I'm a huge art buff, and I love museums. So we got a couple minutes to go. You see things long before everyone else. Can you guide the audience through a potential roadmap of what's to be expected, perhaps between now and the rest of the year?
Well, I think we're going to have to put in more of a fear low on risk assets, and everything seems to be building in that regard. We're starting to see the high yield bond market is basically shut down. There's been one new issue deal in the past couple of weeks. It's not because companies don't want to borrow money at low interest rates, because the market is getting more and more dicey. So I think we're going to see another 10% drop on the S&P 500 before we hit that risk, that fear low. And that could be consistent with sort of a liquidity problem in the lower tiers of the junk bond market. And that should provide, it'll be scary, but that should provide a buying opportunity. We have gone from our most negative possible on growth stocks to only slightly negative on growth stocks. And we have a look to take, as scary as it's going to be, to get positive, quite positive on growth stocks when we get to that fear low. And I think that low will create a rally that is worth participating in. But I think with the Fed doing its tightening and the quantitative tightening that hasn't even started yet, right, we're probably going to be challenged as we go through this Fed cycle until such time as they are forced to capitulate or they break the inflation cycle. So I think this is going to be a year where 60-40 closes the year with a minus sign in front of it. And I do think, though, that the next 10% down that I'm anticipating on something like the S&P 500 will be joined with, be accompanied by a decline in long-term bond yields. So that's what I'm looking for, although I do think that we have sort of a 2.5% interest rate is going to be hard to get below on most spots of the yield curve.
I got you. Well, it sounds like a little bit more pain, but if we can live through this, maybe we'll come out okay. Jeffrey, fantastic conversation. I really appreciate your time. Thank you so much.
Thanks, Charles.
Appreciate it.